Welcome back to The Explainer, where we take all that complex research and data out there and turn it into clear, actionable roadmaps. Okay, let's just dive right into this, because today we're tracking a massive shift in how we actually build a financially secure future. Basically, we're finding that the traditional retirement math, well, it's completely broken. So today our focus is exactly this. The 4% rule is dead, new strategies for 2026 retirement wealth. Honestly, if you're still relying on those old rules of thumb to fund your golden years, you might literally be heading for a cliff.
So, since about 1994, Bill Bengen's famous 4% rule has pretty much been the gold standard of retirement planning. I mean, the idea was super simple, right? You withdraw 4% of your portfolio in year one, you adjust it for inflation every single year after that, and boom, you'll be fine for 30 years. But looking ahead to 2026, Morningstar just dropped their latest State of Retirement Income report, and they lowered that safe baseline to just 3.9%, which begs the question, why is this universally taught 30-year-old rule suddenly being labeled as dangerous? Now, the absolutely crucial detail here is that 3.9% number. On a $1 million portfolio, the actual difference between 4% and 3.9% is only $1,000 a year. That's really not the big deal. The big deal is why Morningstar felt the need to make this shift. See, they aren't just looking backwards at historical averages anymore. They are using forward-looking return assumptions. Modern research points to lower expected returns, way higher market valuations, and this ongoing unpredictable inflation. The economic environment of the 1990s, back when dial-up internet was a luxury and gas was $1 a gallon, it just doesn't exist anymore. Today, the margins for error are tighter than ever.
Kurt Soup over at Creative Financial Group hit the nail on the head regarding this danger. He said, plugging 1994 data into a 2026 retirement is like using a 1994 map to navigate a city that's been completely rebuilt. Really think about that for a second. Planning a modern, potentially 3-decade-long retirement based on ancient economic assumptions is just a recipe for total disaster. The math has changed, and if we don't adapt our strategy, we seriously risk running out of money.
So, why static math fails now? It's actually not just the overall economy that breaks the 4% rule. It's human behavior and real-world realities.
Let's talk about a massive behavioral trap we all fall into. Recency bias. This is our natural human tendency to focus intensely on whatever just happened. Imagine the market suddenly drops. If you are locked into a static withdrawal rule, you're now being forced to withdraw a larger and larger percentage of a rapidly shrinking portfolio. This triggers intense fear. It leads straight to panic selling, and pretty soon people lose all faith in their long-term strategy. We're just poorly wired to be rational investors when it feels like our daily lifestyle is being threatened by one bad week in the market.
And beyond our emotions, actual human spending doesn't follow static math anyway. Economist David Blanchett identified something he calls the retirement spending smile. Your spending is not just this flat line that perfectly ticks up with inflation. In those early years, you spend high: travel, passions, new hobbies. Then in the middle, slow-go years, usually roughly ages 75 to 85, your spending naturally falls. But then, late in life, spending spikes sharply upward again, almost always driven by healthcare costs. The traditional 4% rule completely ignores this human reality.
Okay, the cash flow ladder. We know static math fails. So to build a plan for 2026, we have to pivot to a structured, mechanical approach that actually fixes these flaws.
The core concept here, the whole foundation, is that you absolutely must decouple your immediate spending from market noise. By organizing your money into specific, time-based buckets, you completely prevent a situation where you are forced to sell off your stocks during a market crash just to pay for your groceries that month.
So here is exactly how you build those 3 tiers of retirement wealth. Rung 1 is all about stability. This is your safety net. Think 1 to 2 years of cash or highly liquid, extremely safe assets to fund your near-term lifestyle. It's not there to grow, it is there to protect you. Then, rung 2 is steady growth. This is meant for money you'll need in maybe 3 to 7 years. It's a balanced blend of equities and bonds to keep rung 1 topped up without crazy volatility. And finally, rung 3. That's your long-term growth tier. Heavily weighted in equities, meant to sit completely untouched for 7+ years, just growing in the background. Then, during an annual review, you simply move profits down the rungs, from 3 to 2 and 2 to 1. It keeps your immediate cash topped up, and best of all, absolutely no panic required.
Flexible strategies for 2026. Once you have your money organized defensively, we need to apply modern formulas for safely withdrawing it. While that old 4% rule is totally outdated and rigid, we have way better alternatives now. First up is the guardrail strategy. Think of this literally like the bumpers at a bowling alley.
Your withdrawal rate dynamically adjusts based on market conditions, but it always stays within a safe lane, say between 4% and 6%. If the market drops, you tighten your belt a little. If it surges, you actually get a raise. Then there's VPW, or variable percentage withdrawal. This adjusts your withdrawal every single year based on your current portfolio value and your remaining life expectancy. Yes, your income will fluctuate, but because it's always a percentage of what's left, the mathematical risk of totally depleting your portfolio drops to basically zero.
And here is the massive payoff for setting up a flexible system like this. Remember how Morningstar said the rigid, super safe baseline was 3.9%? Well, we're finding that if you adopt these dynamic, flexible strategies, like guardrails or VPW, you could safely push your initial withdrawal rate all the way up to 5.7%. By simply agreeing to be a little flexible and adjusting your spending to the reality of the market, you unlock significantly more wealth to actually enjoy in your daily life.
Designing your retirement vision. Now, we've covered a lot of the hard math, but honestly, none of those mechanics matter without the vital, personal mindset required to actually make them work.
It sounds cliché, but you really can't hit a target if you don't know your destination. Picking a guardrail strategy or building a cash flow ladder is completely pointless until you have defined exactly what a fulfilled life looks like for you. As Zach Swad from Swad Wealth Management points out, money is just a tool. If we don't use it effectively to experience our hopes and our dreams, well, all the financial math in the world isn't going to make us happy.
So the big question, who are you going to be in retirement? Recent research points out two really common modern personas. First, we have the ageless explorers, making up about 27% of people. They don't even really want to retire in the traditional sense. They want lifelong growth, new passions, and total autonomy. Then we have the comfortably contents. This is about 19% of people, and they are looking to finally slow down and just relax after decades of hard work. Keep in mind, average life expectancy is now 78 years old. We aren't just saving for a few golden years anymore. We have to plan for potentially 20 or 30 years of purposeful living. So, which persona do you identify with?
I want to end this explainer with a really provocative thought from financial life planner George Kinder. Ask yourself, if you had all the money you needed, how would you live your life differently tomorrow? I want you to think about that deeply. True retirement wealth in 2026 isn't just about outliving your money by clinging to some outdated 4% rule. It's about utilizing modern, flexible strategies so your money can confidently fund your ultimate life. Thank you so much for joining me on this explainer. Start building that vision, set up your ladder, and I'll see you in the next one.